Today we're going to tackle a burning question. When the S&P 500 is at peak bearishness, is it a buy sign for stocks? First, let's put on our jargon-busting hats. What do we mean by bearishness? It's when traders think the market is going to drop like a stone. It's like they're looking at the market through doom and gloom goggles. And right now, traders of S&P 500 mini futures contracts are the most bearish on record. We're talking a 25-year high in pessimism here, folks. But wait, what are these mysterious futures contracts? Let's clarify that first. Futures are financial contracts that obligate the buyer to purchase an asset or the seller to sell an asset, such as a physical commodity or a financial instrument, at a predetermined future date and price. They allow traders to speculate on the future price of an asset, manage risk, or hedge their positions. Now, what about these E-mini future contracts? Great question. E-mini future contracts are electronically traded futures contracts that represent a fraction of the value of standard futures. In our case, the S&P 500 E-mini future contracts are based on the S&P 500. They allow traders to speculate on the future price of the S&P 500 index, offering a more accessible and cost-effective way to get involved in the futures market. Now, back to the doom and gloom. If you're thinking, oh no, the end is nigh, just hold on to your horses. Our friend Adam Johnson, author of the Bullseye Brief financial newsletter, reminds us that traders are even more negative now than during the housing crisis, the U.S. sovereign debt downgrade, the Greek bond default, and even COVID. Yet we survived all those disasters and stocks eventually soared to new heights. So maybe it's not time to panic yet. Now, this is where things get interesting. You see, massive bearishness is often a contrary indicator. In simple terms, when everybody's running around screaming that the sky is falling, it's probably a good time to bet on a sunny day. In this case, with record-breaking bearishness, you might want to consider buying into the SPDR S&P 500 ETF, which tracks the S&P 500 index. The logic behind this is pretty straightforward. If all the bears have sold their stocks, there's hardly anyone left to sell, right? So the market more likely is going to rise over time. Of course, the reverse is kind of also true. When everyone's bearish, it might be time to sell. But here's the catch. With so much bearishness and political anxiety, it's tough for investors to buy stocks when it feels like the whole world is selling. It's like running towards the gunfire or running into a burning building. It goes against our instincts. That's why so many investors end up doing the opposite of what's optimal, losing money by buying high and selling low. If you're enjoying this video, by the way, and you want more stock insights, make sure to hit that like button and please subscribe to our channel. In conclusion, history has shown us that epic bearishness on the S&P 500 can be a strong buy sign for stocks. It's like when our buddy Warren Buffett says, be fearful when others are greedy and greedy when others are fearful. So maybe it's time to channel your inner stock market daredevil and consider buying when everyone else is selling. But as always, do your research and make your decisions based upon your own financial situation, and happy investing.